Hello, this is Private Family Banking Partners. Thank you for tuning in to our seminar today. I'm going to share with you how to build wealth and keep it like the Rothschilds. So wealth is not measured by how much money you make, but it's measured by how much money you keep. And this principle is illustrated by the story of two men. One of those is Cornelius Vanderbilt, who made his wealth in the railroad business, and the other man is Mayer Rothschild, who was a banker. Now, Vanderbilt died in 1877, and he had amassed a fortune of $105 million. That's Bill Gates kind of money in today's economy. In 1877, that was a huge fortune. He left $1 million to Central University, and they renamed that university to Vanderbilt University, which is probably why most of us remember the name Vanderbilt at all. And he left $104 million to his heirs. 92 years later, his heirs got together for a reunion at the college. 120 Vanderbilt descendants gathered, and interestingly enough, there wasn't a single millionaire among them. And so all of that money over those 92 years had been dissipated. Now let's contrast that with the story of the Rothschilds. Mayer Rothschild died years before Vanderbilt did in 1812, and he had amassed a huge amount of money, but not near as much as Vanderbilt had. And instead of leaving all of his money to his heirs, he left them a system for building family wealth. He left them a banking system, if you will. And this is what that looked like. Number one, the family's wealth was to be kept together in one family bank. Step number two, the family could take a loan from the family bank anytime they wanted to, but they needed to pay the loan back. And then step number three was that once a year the family met together and shared their lessons learned, what worked, what didn't work, how money grew, how money didn't grow. And if they didn't do these three steps, they were out of the family bank. And currently, the Rothschild fortune is estimated to be somewhere between $1 and $100 trillion. Nobody knows for sure. It's so much. The difference was he left a system for his family to operate within. And so it's not just time passing that causes money to dwindle away. It's whether or not you have a plan. And tonight we want to share with you a plan for building wealth. Now, the average American, he makes $1 million in his lifetime, but he doesn't keep it. For example, if a person earns $50,000 a year and he saves it all, and if he could grow that savings at just 5% a year, after 40 years, he would have $6 million. So let's look at this little calculator. Annual income is $50,000. If you grow it at 5%, you're going to have $6 million at the end of 40 years. But one of the wealth stealers that we have to deal with in this world is taxes. So let's assume that person's in the 28% tax bracket. Let's see what that does to our nest egg. Okay, well, we lost quite a bit of it. It leaves us $36 after taxes of that $50,000 that we earned. And now we have to spend money. We have to buy groceries. We have to pay for utilities. We need transportation. So let's say this person spends 90% of that after-tax money and see what happens to what he's got left. Wow, that makes quite a significant difference, doesn't it? And this person, we're going to say, is very conscientious. They save 10%, but you see over 40 years the loss of what could have been. And what do? We spend all of our time trying to cause that 10% that we might save, most people don't save that much, to grow at some rate so that we can get ahead. Well, obviously, that's not going to work. Most people think that to get ahead, they must work harder, they must stop spending, or they've got to take on more risk. Well, we can't work any harder than we do sometimes. Sometimes you get to the point where that's all one person can do. So that's not the answer. Stop spending. Well, we know that's not the answer, because there are things that we must have. There's family needs that we must take care of to take care of our families. So we can't just stop spending. And so that leaves us, well, we must then take more risk. And we've been taught that this is the way to get ahead, but really I think that that's something that is not really true, that we've been taught over the years. So is there a better way? Yes, there is. Let's look at 3 ways to view money. We can view money as a spender, we can view money as an investor, or we can view money like a banker does. The spender, he views money as a way to get stuff. Okay, we need to buy things, and every purchase that the spender makes is going to cost him interest. If you borrow and pay for your spending that way, you're going to pay interest. If you're like me and you save money until you accumulate enough to buy what you need and then spend it, well then what could have earned more money, more interest, more compounding, we have to give that up. Either way, we never build up any money. Let's take an example of buying cars as one way to illustrate this point. There's 3 ways that we can buy cars. We can borrow cash from a financier or a finance company or a bank or a credit union and pay for the car that way, giving up interest, paying interest for that. We can save up money and then pay cash for the car, or we can use the private family banking system to purchase our cars. Let's look at another graph here. Let's say the cost of the purchase of a car is $30,000. When we're younger, maybe the car will cost a lot less than that. As we grow older and a little more affluent, hopefully, we might pay more than that for a car. But let's just say over the average of our buying cars in our lifetime, that the average is $30,000. If we're borrowing, let's say we pay 5.5% and we purchase a car every 5 years. After 11 purchases over 55 years, the borrower has spent $378,203. The cash buyer, he's been a little smarter maybe. He's only spent $330,000 because he hasn't paid any interest. But what about the bank? This is what we don't think about. What did the banker do? Well, he didn't make the car. He didn't sell the car. He didn't even buy the car. He just acted as the middleman for the guy that's saving his money and buying cash, and the guy who's borrowing that same money usually and paying interest for it. What does he make? Let's look down here. The banker makes $380,820. That's why people spend a lot of time and resources to build a bank, because you're going to make money no matter what. Whether you're a cash buyer or like I used to be or a borrower, you're going to come out ahead, $380,000 ahead. And so the banker is who you want to be. Let's take a look at this another way. Let's say let's talk about buying a $20,000 car. The borrower goes to the bank and he borrows $20,000, and then he pays off $5,000 and those $15,000 the first year. Then he pays off another $5,000 and those $10,000 the next year. He pays off another $5,000 and those $5,000, and then finally he pays the car off, and he's back to zero. What does he do then? Well, it's time to go buy another car. So he starts the process all over again. Borrowing, paying back, borrowing, getting to zero, and going down again. And at the end of his career of buying cars, what's he left with? He's left with zero money and an old car. Well, let's take a look at what happens to the cash buyer. Now, he's a little bit smarter, so he spends 1 year and he saves $5,000. The next year, he saves another 5. He's got 10. The next year, he saves another 5. He's got 15. And finally, he's got the $20,000. So what does he do? He liquidates that $20,000, and now he's left with zero, but he's got a new car. And then what does he do? Well, he better start all over again. You see, the car payments really never go away, because if he doesn't start saving that $5,000 each year and accumulating that each year so that he can have $20,000 for the next $20,000 car, he's going to end up being a borrower. Either way, you're on a race to zero. What's he left at the end of his lifetime of buying cars? Zero money and an old car. So let's take a look at what the private family banker, what his system looks like. You see the red and the blue, that's the borrower and the cash buyer. The private family banker is building up, and over his lifetime of purchasing cars, he ends up with several $100,000 and an old car. Tonight we want to show you how you can do this for yourself. Let's take a look at the investor, though. Remember we said you can look at it 3 ways: as a spender, as an investor, or as a banker. The investor views money as a way to buy investments. He trades his money for something that he hopes is going to go up in value, and he also hopes that when it does, he's going to be able to find someone that wants to buy it at that increased value. And every investment exposes him to another wealth stealer, which is risk. And every gain costs him taxes, another wealth stealer. And so he's exposed to risk and taxes each time he's making a purchase. Imagine this. If you start off with $100,000 that you invest, and let's say that investment goes up 10% the first year, and then the second year it goes down 10%. Are you ahead, or are you back where you started? Well, if it goes up by 10%, you have $110,000, and if it goes down by 10%, well, you've lost $11,000. You're down to $99,000. So you're not back where you started. What if you go the other way? What if it loses 10% the first year and gains 10% the next year? Are you back to even? Well, no. If you lost 10%, you've got 90, and if you gain 10% of that, you've got 99. You're still behind the 8 ball, so to speak. That's the investment risk game. Okay? If you lose 10%, you're going to need to gain 11% the next year to be able to break even. If you lose 40%, you've got to gain 67% just to break even. If you lose half, like a lot of people I know did in 2008, you've got to have 100% gain in order to get back to even. And I even have some friends that lost 100%. Well, what do they have to do to get back to even? Well, they can't get back to even. They lost it all. They're broke. They got to go back to work. So that's the investment risk game. And not only does risk hinder us from building wealth, but so does taxes. Taxes destroy our money's wealth. Let's take a look at this next calculator. This calculator shows what happens if we can take $1 and double that dollar every year for 20 years. After 20 years, if we double just $1, it starts off slow, but it picks up a lot of momentum. After 20 years, you've made over $1 million. Okay, but wait a minute, we've got to pay taxes, don't we? There's nothing more sure than death and taxes, right? So say we're in the 28% tax rate. If we're in the 28% tax rate, all of a sudden that $1 million is going to turn into something less. Let's take a look at what that is. Oh, wow, that took a big hunk out of what we made. Now we've got $51,000. What if we're in the 35% tax bracket? Look at this. Now that $1 million becomes $22,000. The government, if you notice from the last slide, makes less money too as we go up. Let's kick that tax bracket up to 45%, and just notice this. The government made 12,000, now they're only making 5, and we've taken an even bigger hit. So raising taxes is not a wealth builder, is not the way to get ahead for the government, and it hinders us from gaining wealth too. Let's take a look at how a banker operates, though. The banker views money as a way to make money. Every purchase is an opportunity to make a gain, and the banker always keeps his money working. Once it's purported that Albert Einstein was asked what was the greatest force in the universe, and rather than saying nuclear fission or gravity or something like that, he's purported to have said the most powerful force in the universe is compound interest. Compound interest, that's money making money and making more money on the money it made. It puts us on what I like to call the wealth curve. It's money working overtime. Private family banking allows you to become your own bank without the time restraints of having to get a charter, which takes decades sometimes, without having to put up millions of dollars in security to do that, without then having to build a building, hire staff, get deposits so that you can lend those deposits out and make money. You can start your own bank without all of those circumstances coming into play. And we can stay on that wealth curve for the rest of our life. What happens to most of us and that wealth curve is we fall off the wealth curve. The broken line shows what happens if we put our money in, earning compound interest, and it continues to earn for our lifetime. Just falling off of it one time to purchase a car or whatever, look at the difference it makes over our lifetime. And we fall off of that wealth curve multiple times. You see, every purchase costs us interest. We either pay up and borrow the money from someone else, or we give up interest that we could have earned on our money. Well, what if we could use our own money without giving up the interest that it would earn? You'd probably say, you've got to be kidding. That can't happen. That's exactly what banks do. Banks take deposits. They lend those deposits, that money, to others and charge them interest for it. And at the same time, they earn interest by keeping their money working continuously. They create a pool of money, put the money to work earning, compound it, and then they use that pool of money as collateral when they need cash. That's what starting a private family bank is all about. We'll show you how to create your own pool of money. Put that money in a place where it is guaranteed to grow compounded, and then use that money whenever you need it by taking out a collateral loan when you need the cash. If your money was earning 4%, would it make sense to borrow money at 6%? Intuitively, you'd say no. I saw this question the first time, and I said, obviously no. It's better to liquidate and then make my purchase because I'm paying higher interest. But you know, that's a false assumption. Let's look at this $20,000 car, for example. and we pay for 48 months at 6%, our payments are going to be $470 a month. The total outlay for that car over 4 years is $22,546. If at the same time that money was in our savings and growing for those 48 months at 4%, we would have, over that same period of time, $23,464. Well, let's change that to that $30,000 car that we're now purchasing. And we're going to finance it for 60 months for 5 years at 6%. Our payment's $580. So our total outlay is $34,799. $4,799 we're paying in interest. If that same money was earning at 4% over those same 60 months, our future value would be $36,630. So we actually are coming out ahead by borrowing the money and paying interest and keeping our money working at 4%. So what if you can take over your own banking function and say, let's make the loan interest rate 5%, and we earn at a rate of 5% also. Well, then you're going to see that difference is fairly significant. And that's what we can do as a private family banker. It makes sense to do it this way. So where do we put our money to do this? Well, there's 3 places where we've been taught to put our money. One of those places is we put our money in the stock market. But we all know the stock market goes up and the stock market goes down. We've had crashes on the average about every 8 years. We saw the stock market lose in 2000 at Y2K. We saw the stock market lose during 9/11. We saw the stock market lose again in 2008. So the stock market goes up and down, and although you can make money when it's going up and when it's going down, there really is a lot of a risk involved, and we've got to have some luck behind us so that we can time those up and down movements just right. It's not a very safe place to put our money. Another place where we've been told that's a good place to put our money is in real estate. But those of us that live in Phoenix and those friends that I have that live in Las Vegas know that in 2010, that was not a good idea to have our money in real estate. And a lot of people are upside down in their mortgages as a result of that. The third place that we can put money is in financial instruments that have guarantees. What are those kind of financial instruments? Well, savings accounts have guarantees. CDs have guarantees. But if you're utilizing those right now, it's like putting your money in under your mattress, isn't it? The other place where we can put our money is in insurance contracts. Insurance contracts are safe, they're liquid, they're guaranteed to grow. And right now, they're growing at around 5%. If we were to list the ideal objectives of where we wanted to put our money, what would we come up with? Let's take a look at some of these. With risk, would we want to have something that had no risk involved with our money? Yes. Would we want guarantees? Absolutely. Would we like no penalties associated with our money? In other words, we can take it out whenever we want. We don't have to wait till we're 59 and a half, and we don't have to start taking it out if we're 70 and a half. There's no penalties. We can use it whenever we want to. Well, yes, that would be a good place to put your money. How about liquidity, use and control? Would you like to be able to get to your money whenever you needed it? Well, yes, absolutely. Would you want to be protected from creditors and judgments? Yes, definitely we'd want that. How about leverage? Would you want to create the most amount of money, the most amount of wealth using the least amount of money? Absolutely, yes, we would want that. We would want it to be tax deferred. Would you want your money to grow without having to pay taxes until later? Well, yes, but maybe that's not such a good idea, as we'll see in a minute. Would we want it to be tax-free when we want our money, when we distribute it to our heirs or for our own use? Would we want that to be tax-free? Yes. Would we want our money to be available for collateral loans? Yes. All of those things are important for us. Would we want it to be tax deductible? Would we want a disability benefit? Would we want our wealth transfer to our heirs tax-free? All of the answers to those are yes. Well, let's compare that with those components with what we are already funding. This chart shows your answers on the right in the green. They're all yes, but then it shows IRAs, brokerage accounts, real estate, CDs, annuities, real estate, and just look at the answers there. Mostly no's, a few maybes, a couple of yeses for all of those things where that's what we want. And yet we keep funding these things instead of using our money and putting it somewhere where we can have what we want. As far as tax-free or tax-deferred growth goes, I saw a report from the GSA recently that said they were collecting $1.15 trillion in taxes this year. And the goal is that in 5 years, they're going to collect $2.5 trillion in taxes. Well, I think it might be a good idea to pay our taxes now when we know what they are, rather than wait till later when they're obviously planning on the tax being higher. Private family banking, what is that? Well, we use the same financial instrument that banks and big corporations, people that know about money, that know how money works, we use the same instrument that they use to park their money in a place that's safe, that's guaranteed to grow. Banks put their money in what is called BOLI, or bank-owned life insurance. Most banks hold it, and it's recommended to them by the FDIC. You see, permanent whole life insurance, especially from a mutual company with participating dividends, is a safe and liquid way to hold and use capital. What we do at Private Family Banking Partners is we customize your life insurance policy so that it gives you liquidity. You have safety. They guarantee the growth. Your money is protected from taxes. It's protected from judgment and lawsuits also. How can we do this? Well, our special customized policies look like this. Here's 3 types of insurance. The red line shows what term life insurance looks like. It buys the most death benefit for the least amount of money, but after the term is over, you're left with nothing. And if you want to go for another term, it's going to be more expensive. So term insurance doesn't build up any cash for you. The typical whole life insurance policy, which is what we hear of from financial gurus that tell us that it's not a good place to put your money, looks like what's illustrated in blue. And for the first few years, it doesn't grow much money either. But after a couple of years, it starts to grow some cash value, and then it continues to grow cash value over its lifetime. The private family banking optimized whole life policy is illustrated by the green boxes there. We optimize your policy so that it builds cash immediately, that you can use immediately, and it grows exponentially, kind of like the wealth curve, because when you put it in, and you utilize our system, it continues to grow, compounding interest. That's the difference between what we are recommending and the typical whole life policies that some financial gurus say we should never use. Private family banking. If you control your own banking system, you can capture the interest that you've been paying to someone else. This is what it looks like. The average American spends about 20% of his income on automobiles and transportation. About 30% goes to housing, and about 40% goes to living, and we try to save 10%. At least that's what we're told to do. The actual rate is probably closer to about 6% for the average American. Well, of that money that we're spending on autos, housing, and living, about 4.5% for autos is going to interest. About 25 of the 30% that we spend on housing is going to interest. And about 5% of what we spend on living is going to interest. That's 34.5% spend on interest. What if we could capture that interest that we've been paying to others? The interest portion. We make premium deposits or premium payments, depositing that money into our policy or money pool, and then we can use that and take loans and repay those loans to purchase cars. We can, instead of using credit cards, we can use loans and pay back as if we were paying back a credit card. And ultimately, we're going to be able to take over our own mortgages. My wife and I have been able to do that after just 5 years of putting our money into this system. And so what does that do? How would our savings change if we could recapture the money that we're throwing away on interest? It would look like this. Instead of just saving 10% and making that grow, look at the return we're getting if we can just recapture the interest that we're paying someone else or that we're losing by paying cash. Here's another way to illustrate that. Okay. Over the years, that green shows what we're gaining and what's going to interest payments. If we put that interest payment on our side, it's like riding a tailwind instead of going into a headwind. The benefits of private family banking. It's life insurance, so it provides a death benefit for our heirs. We can use it for major medical expenses, like an HSA, without any of the penalties or any of the requirements that has. We can use our policy as for disability protection by using a rider. We have guaranteed access to it, so it can become our emergency fund. We can use it as a college savings plan, as a 529 plan is set up, without the limitations or penalties that are associated with that. We can use it for our retirement without the penalties or limitations associated with that. It's protected in the case of a lawsuit. We have tax protected growth like a Roth, and it's an estate planning tool also. And so I want to encourage you that there's other ways that you can utilize this private family banking system too. You can take over your debts. You can build a retirement plan, as I said, pay for college, finance a business, build multi-generational wealth. Give us a call. Thank you for listening to this seminar. I hope it's stirred some questions and gotten you to think about things a little bit. I'd be happy to give you a free financial analysis. An appointment takes about an hour at Private Family Banking Partners. Thanks again for listening. God bless.